We begin this morning with new numbers just in on the economy. The U.S. added 206,000 jobs in June. The unemployment rate rose slightly to 4.1%. And this, of course, comes amid high interest rates as the Federal Reserve tries to lower inflation. I want to bring in a New York Times Federal Reserve and U.S. economy reporter, Jeanna Smialek, for more on this. Jeanna, good morning, and thanks for being with us. How should we read today's data from the Labor Department?
Yeah, thank you for having me. I think that it's a little bit of something for everybody in this one. I think that tick up in the unemployment rate to 4.1%, which is the highest we've seen since 2021, is definitely going to catch the eye of Fed and monetary and economic policymakers in the country. I think that it's a sign that the labor market might be on the cusp of weakening. At the same time, that headline jobs gain, that 206,000 jobs that we added in the month of June, is a really strong number. It's actually much stronger than what economists had forecast. And so I think that the overall takeaway here is that the labor market isn't falling apart, but it does seem to be weakening around the edges. And that's something to watch going forward.
In your live blog this morning for the New York Times, you wrote that it's definitely got some details that will keep them wary that the job market, as you mentioned, is on the cusp of slowing. Other than what you just mentioned, the slightly higher 4.1% unemployment, what other details could signal potential slowdown and maybe influence the Fed in their September decision?
Yes, I think there are two big ones. I think the first is that wage growth is really starting to slow pretty notably. So average hourly earnings comes out every month in this report. And we've just been watching those numbers tick down over the course of the last year. It fell to 3.9% in this report. That's much slower than the sort of well above 4% numbers we had been seeing last year. So I think that's one thing to keep an eye on. I think the other thing that really matters from this report is while we did see a really strong headline jobs gain number, it wasn't very broad based. It was really heavily concentrated in some of the sort of public sector related job descriptions. And so healthcare, teaching, things like that. And I think that is actually probably something to watch. That kind of concentration suggests that this isn't the sort of robust, very strong labor market with broad-based gains that we had been witnessing for the last couple of years. And so I think that sort of those twin factors will really, really keep the Fed wary about this job market.
So we are parsing out some details, but if we want to take a 30,000-foot view, do you find in your reporting that there's a disconnect between the data that we're seeing month to month of a relatively strong economy and how Americans are viewing the labor market, viewing wages?
Yeah, I think this is really interesting. I was actually in Pennsylvania doing some reporting this week and kind of roving around and talking to people. And when you talk to people on the street, they usually won't complain about the sort of state of the labor market. They'll tell you that they've got a good job, they're pretty pleased with their job, they're making better wages, they're getting pay gains. But then the second thing they will tell you is, I don't feel like I'm getting ahead because of the inflation, because prices are so much higher. And while we know that inflation has slowed a lot since its peak, we also know that that means that price levels are a lot higher than they were just a couple of years ago because rapid inflation sort of compounds upon itself. And so I think that combination of higher price levels with a strong labor market has helped to really take the shine off of the strong labor market. You don't feel good about your job situation if you feel like you're not necessarily getting ahead.
I have to be real quick with you on this, but am I correct that the next time the Fed is going to meet in September, and are you thinking there might be a quarter percentage cut?
Investors are certainly thinking that. And this jobs report this morning, I think that tick up in unemployment really confirmed for them that that's a big likelihood. So we saw expectations rise a little bit for a September cut. So maybe lower rates to come.
Jeanna Smialek, so happy you could join us. Thank you so much.